Hey guys, welcome to our channel. In this video, we are going to see about Economic Capital Framework by Bimal Jalan Committe and RBI surplus fund transfer to the government based on the committee's recommendations. Recently, RBI has decided to transfer Rs 57,000 crore to the government as a dividend for the accounting year 2019-2020. Prior to this, last year, the RBI had transferred Rs 1.76 lakh crore based on the recommendation of the Bimal Jalan Committe to transfer the excess reserve to the government. This 1.76 lakh crore was the first huge transfer from the Reserve Bank of India to the government based on the revised economic capital framework. Why RBI transfers surplus to the government? As we all know, in 1935, RBI was formed as a private shareholder bank. But it was nationalized by the government in 1949 and the government became the sole shareholder of the Reserve Bank of India. Therefore, every year RBI will transfer the fund to the government as a dividend from its net profit after setting aside fund under capital reserve to meet any risk. RBI transfer of surplus to the government is in accordance with Section 47, Allocation of Surplus Profit of Reserve Bank of India Act 1935. RBI is earning income through the following ways. Interest earning from the loan given to the bank, then interest on the government bonds and securities, as RBI is maintained the various foreign currencies and the deposits of various central banks, so it will earn the income through it. Then as a manager of the central and state government borrowings. As a central bank, its mandate is to manage different types of the risk. For example, market risk arising out of the currency, then the monetary and the financial stability risk. To manage these type of the risk, RBI is maintaining a fund called contingency fund under its capital reserve. Every year, RBI allots money out of its net incomes to its capital reserve. This fund allocation will be depend upon the risky situation in the financial system. In this way, RBI is maintaining its reserve to manage various type of risk and transfer rest of its net income to the government. If we look at the international practice with regard to the surplus transfer from the central bank to the government, there is no internationally laid down risk capital framework for central bank. Central bank across the countries develop different risk management framework depending on their specific conditions and the requirements. Likewise, in India, there is no explicit policy on the distribution of the surplus to the government. It is decided based on the recommendation of the various committee from time to time. First committee constituted for economic capital framework was V. Subramaniam Committee in 1997. It recommended that 12% of total assets of RBI should be kept aside as a contingency fund. In 2004, Usha Thorat Committee recommended that 18% of total assets of RBI should be kept aside as a contingency fund. Then comes the YH Amalgam Committee. It just mentioned that adequate amount of funds should be transferred to contingency reserve out of the balance sheet of the RBI. Final and recent committee constituted for this economic capital framework was a Bimal Jalan Committee in 2018. This image shows the RBI surplus transfer to the government over the years. If you see, after 2013-14, there is a hike in transfer compared to the previous year. It is due to the recommendation of the Amalgam Committee. Then the high transfer in 2018-19 was a result of RBI Central Board accepting all recommendation of the Bimal Jalan Committee. What's the need to constitute the new committee in 2018? The committee was formed due to the reported friction between the Reserve Bank of India and the central government on the issue of transfer of the surplus. Government has held the view that going by the global benchmark, the RBI reserves are far in excess than the requirements. Therefore, committee is constituted to resolve the issue. What is economic capital? Economic capital of a central bank includes its capital, risk provision and revaluation reserve. Risk provision means maintaining different fund to meet various risks. In the revaluation account, there will be a factors which is being revalued. For example, currency, gold, investment made in foreign securities, then the foreign exchange. Economic capital frameworks mainly deals with how much amount should be kept as reserves by Reserve Bank of India and how much it should be transferred to the government. These are the 5 components of RBI capital reserve. First two fund, that is contingency fund and asset development fund, is included in the risk provision. Contingency fund includes the provision for unseen contingencies arising due to the monetary and exchange rate policy risk. In the asset development fund, the amount will be set aside for investment in subsidiaries and internal capital expenditure. These risk provisioning made from economic capital to cover monetary, fiscal stability and operational risk is referred to as contingent risk buffer. The remaining 3 is accounted in revaluation reserve. One thing to be noted that the revaluation balances are the major components of the RBI's economic capital. It constitutes around 73%. Even though RBI's economic capital could appear to be relatively higher, it is largely on the account of revaluation balances which are determined by exogenous factor. In the revaluation balances, there can be a gain or loss based upon the external factor. In the revised economic capital framework, the committee has suggested that a distinction need to be made between the realized equity and revaluation balances in the RBI balance sheet, as the latter part is highly volatile. If you see the recommendation of the previous committees, the target will be based on the total economic capital of the Reserve Bank of India. But Bimal Jalan Committee stated that revaluation reserves represent unrealized valuation gain, therefore it is not distributable. Therefore, committee categorized economic capital into realized equity and the revaluation reserves. As we discussed earlier, realized equity includes the interest earned from the loans given to the banks, interest from the government securities and bonds as a banker of central and state government. And in the revaluation reserves, there will be foreign currencies, gold, and deposits of various central government. Moving on to the surplus distribution policy, the committee has suggested that the size of the realized equity in the form of contingent risk buffer must be maintained between 5.5% to 6.5% of RBI balance sheet. If the realized equity is above this requirement, then the RBI should transfer entire net income to the government. In 2018, realized equity level was 6.8% of RBI balance sheet. After accepting the committee's recommendation, RBI transferred this excess reserve to the government. Then with respect to the total economic capital, it should be maintained between 20.8% to 25.4% of the RBI balance sheet. I think now we got the clarity about the economic capital framework and the recommendation by Bimal Jalal Committee and the subsequent RBI transfer to the government. Thank you.